Good day, and welcome to the next session of NCREIF Analytics on Demand Education. This module is a 10-minute introduction on how to apply NCREIF Analytics to a real-world business problem. In our first use case, we will use NCREIF Analytics to help us better understand why our industrial asset in Houston might be underperforming the market. We are going to use NCREIF Analytics to help answer the question of whether this is a market issue or specific to the asset, and what might be the cause of this underperformance. Using NCREIF Analytics, we will explore information from NCREIF's database of over 10,000 properties. The tool will enable you to better understand the market performance of the NPI, the industrial sector, and the Houston market. Let's start by opening the Market Performance Report. The Market Performance Report looks at the total returns of a market compared to the nation. By default, the report opens by showing the United States and each of the 4 property types. In the short-term chart on the right, you can see the U.S. industrial sector in orange has not as much of a drop in returns as the other sectors. If you scroll down, you can see the longer-term views. The bar chart shows that the industrial sector's longer-term performance is similar to the U.S. overall. Also note the 20-year risk statistics. The industrial sector has had a 1.0 beta and an 8.6% annual standard deviation, similar to the overall NPI at 8.5. We can see this represented in the risk-return chart. Over the past 20 years, the industrial sector in orange has had similar risk-return characteristics as the U.S. in dark blue. This quick analysis shows that the underperformance of our industrial asset does not appear to be due to the overall industrial sector. Maybe the Houston market is the issue. Let's look there next. By changing the dimension to CBSA versus US, the property type to industrial, and geography to Houston, and then selecting update, we can see how the Houston industrial market is comparing to the overall NPI. Houston overall performance in light blue had a more severe downturn than both the Houston industrial market in dark blue and also the overall NPI. Also note that the Houston industrial market is underperforming the U.S. industrial sector over the last 2 years. Scrolling down to the longer term view and focusing on the bar chart, we can see that over 10 to 25-year periods, Houston industrial in dark blue has outperformed. Let's look closer at the risk statistics over the 20-year period. Houston industrial had a measured standard deviation of 6.6%, almost 200 basis points lower than the NPI. Also note the low correlations of the NPI, particularly for Houston overall, at 82%, due partially to Houston's oil-based economy and its economic cycle being slightly different than the overall U.S. These two statistical measures are part of CAPM's theory, alpha and beta equations, and why Houston has a low beta and a high alpha. Remember, a low beta implies that Houston's industrial is less correlated and or less risky than the overall market and offers good downside protection, but may underperform in an up market. Following CAPM theory says that adding low beta markets to your portfolio lowers overall risk. However, and this is a huge however, many factors affect risk, including the number of properties in the sample, and that these characteristics also affect other risk-adjusted measures, such as alpha, beta, and correlation. More importantly, adding one asset to a portfolio is not the same as the market risk. This analysis does point to the possible Houston market effects contributing to the underperformance. Let's see if we can spot any trends in the operating data that may assist us to better understand what's happening. Let's open the Market Operations Report for Houston Industrial. This report displays a series of key performance indicators, or KPIs, constructed from the property cash flows NCREIF collects quarterly. In this 10-year view, we can see Houston industrial vacancy rates are below the lows in the last cycle. However, they have been rising over the past year. Scrolling to the cap rates, we can see that Houston's industrial cap rates are about 50 basis points higher than the US, a lower spread than in 2007, when Houston's vacancy rates were higher. Scrolling to the next section, we can look at the NOI growth of Houston Industrial. There are several things to point out here. First, NOI growth is an extremely noisy data series, and it takes several hundred properties for a very good sample. NCREIF's annual same-store growth methodology helps smooth some of this noise. In the past recession, Houston's NOI growth did not suffer as much as the nation. Thirdly, Houston's NOI growth has been high this past cycle, but overall Houston NOI growth is slowing. In summary, Houston vacancies have risen, cap rate spreads have narrowed, and NOI growth is high and very volatile. Are these trends affecting your property? Is your asset tracking the market? We'll answer this question on another day. Thank you for listening. This wraps up the NCREIF On Demand Education module. If you have any questions, please ask the question to the knowledge base or call the staff at NCREIF. Thank you.